Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast. What should you be doing with your mortgages right now? If you're buying or remortgaging, there's so many decisions to make. Fixed, variable, long-term fix, short-term fix. Well, today, with the aid of an expert, we give you all the answers and all the guidance that you need to be making the best decisions.
Welcome to the Property Podcast, where we take time out from advising a multi-million-pound property fund and putting together hundreds of deals every year for our clients to bring you some of the knowledge we've gained along the way for free. And like we are today, bringing some of our network in to do the same. So we are going to be helping you through the number one issue that investors are grappling with right now. And make sure you stick around to the end, because in Hub Extra, we're sharing something we've been watching, which is both going to entertain you and inspire you.
First up, it's time for our news story of the week. And I must admit, I nearly missed this one because the headline isn't grabby. It's Welsh Government Green Paper. That's it. That's the headline. But luckily, Rob, you were aware that this actually meant something and told me to click on it. And it's not just our Welsh listeners who'll be interested in this, because what's proposed here may be adapted elsewhere.
Yep, because the slightly more exciting headline beneath the headline is that the Welsh Government is looking at rent control. Yep, it's kind of happening in Scotland, albeit on a very long-term temporary basis. And now it's being talked about in Wales as well. At the moment, this is a consultation, but as we all know from consultations, it really means it's going to happen, and we just want a tiny bit of input maybe into how it happens. So while there's no date on this yet, it seems highly likely that some form of rent control is going to be in the future for Wales. We'll come back to this in our monthly market update, because some of the models they're suggesting for rent control in this green paper are bonkers, and one of them, actually, by my reading, is better than not having rent control at all. It's seriously weird. But for now, if you are an investor in Wales, you just need to be aware that this may be coming. And again, if you're an investor anywhere else, it's worth keeping an eye on these things, because the government has repeatedly said that they've got no interest in rent controls in England. But governments have been known to change their mind. And if the talk does start one day in England about rent controls, knowing how it's being implemented and how it's playing out in other areas of the UK will make you far better informed and better able to make decisions about it. So this is a story we'll be coming back to.
Before we bring you up to date on everything that's happening in the world of mortgages, we've got some very, very exciting news. We are launching something new, and it's exclusively for anybody who works with us. So whether that's through Portfolio or through Property Hub Invest, what we are launching is something that we are calling Property Hub Select. Property Hub Select we will talk about more in the future, and you'll hear a lot more about it. But we are very excited because, amongst other things, we are bringing live events, we are bringing back in-person meetups, we are doing live podcasts, and so much more. It's going to be the coolest club in town. Rob, I'm really excited that we're doing all these eventy type things again. I'm really excited that we're creating something so valuable for all the people who invest in our services, which is super cool. Property Hub Select is going to be absolutely awesome.
It really is. And don't worry, we're not going to start holding anything back on the podcast. We've never been in the business of going, well, here's some, but if you really want to know the good stuff, then you have to come and pay us. Not going to start doing that. But by being able to speak to a different group in different formats, including in person, it just means that we're able to share information and explore important concepts in a way that we can't do anywhere else. I mean, Rob, we're planning out the first couple of events now. We've locked in the topics for the first online masterclasses, which I'm super excited about. This is the kind of stuff that you see people pay thousands of pounds for like some kind of mentorship or whatever. But Property Hub Select is only available to our clients, and it's free.
Yeah, it's brilliant. And the great thing is, it's just a massive value add-on. No catches. It's just for those people who are going to work with us. So if you're going to work with us anyway, then brilliant. For those who already use our services, we'll be emailing you this week to give you all the info. But if you were thinking about using our services in some point in the future anyway, and you want to get involved with Property Hub Select and join us at these meetups and these live events and these online masterclasses, then go to propertyhub.net/select. That's propertyhub.net/select. We'll leave it there. There's probably going to be loads of you hitting that website after this, but we will give you more info in the future. We'll tell you more about those live events. We'll tell you more about the online masterclasses. There's so many exciting guests lined up for those. So that's all to come. But your first step is to go to propertyhub.net/select.
There is no doubt that the hot topic of the moment, even hotter than house prices, is the mortgage market. It is a crazy time, and everyone wants to know what they should be doing, how they should navigate this, when every week there seem to be rate changes and new products coming and going. We like to think that we know a fair bit about this topic, but we are not true experts. We don't spend all day, every day at the front line of mortgages. But our guest today does. Nick is Managing Director of Framework Mortgaging, a specialist broker based in Manchester. And he's got over 35 years of experience in financial services and property investments. And we'll put his details in the show notes.
So it's a really crazy time right now in the mortgage market. Everyone in the property world is talking about mortgages, what they should be doing. We've got interest rates rising, we've got products being added and then products being pulled. So we had to start the interview asking Nick about the current state of affairs in the mortgage market. And had he ever seen anything like this before?
We are certainly in a unique time resulting from extraordinary events. My outlook is optimistic but pragmatic. It's not panic stations. Focusing on buy-to-let for a second, the sentiment is that lenders are waiting for stability in the market before they can price their products with confidence. Unfortunately, we're seeing products withdrawn from the market due to volatility in the lender cost of funds. We hope the expected base rate increase will ease inflation further and spread much needed stability within capital markets.
So what's actually happening out there? Can you give us a snapshot of what's going on with the base rate, swap rates, and how lenders are reacting?
Yeah, so the swap rate saw some volatility throughout May, which led to the recent withdrawal of numerous products. Unfortunately, it's like a pack of cards. When one lender removes their products, others will follow suit. This isn't only because of the cost of funds. Lenders will want to manage capacity and their USP or placing in the markets. Not all lenders will want to be the lowest cost. Some have specific price points and ideal client and security. The base rate, I feel, is projected to increase by another 25 to 50 basis points in June. This is in line with many original projections of reaching 5.5%, so the current raises were expected.
So this volatility that we're seeing, do you see it lasting much longer?
Generally, volatility is short term, and I'm hoping we will start to ease into our new normal Q1 next year. This doesn't mean we won't see competitive rates now and before that. Lenders do have conservative product ranges, which we are seeing now, but they will issue limited edition competitive pricing when they see fit, so when the volatility eases. They label these products limited editions, I feel, so they can remove these at a moment's notice when we do hit some volatility. I still think that buy-to-let rates and products are agile enough now to carry us through the current environment. The ultra-low rates are a long way off. The focus should be on selecting the right product, with the focus solely not being on the interest rate. There are various ways to cushion any anxieties concerning rates. For example, clients may feel that products that allow further advances or have lighter or no early repayment charges might mitigate some current rate concerns. The current rate climate also highlights that it's important to buy well because better quality investments and less tenant attrition will lead to less strain on your cash flow.
What kind of knock-on effect is this causing? Are you seeing a drop in applications for both new mortgages and remortgages because of this uncertainty?
With my clients, it's business as usual. We focus on buy-to-lets and building portfolios over the long term. So clients are still purchasing because we share that long-time view with vanilla buy-to-let. Clients are seeing some good opportunities, some good price points, and then that does mitigate the current rate environment. It's certainly a more considered approach with buy-to-let, but there's still a lot of activity. Residential purchases have naturally slowed. Affordability is a hurdle to go through, and people are just managing their households more carefully.
Now, we know that everyone's circumstances are very different and you can't give actual advice, but for those coming to the end of a fixed period of their mortgage, what should they be doing?
Proactivity is important. With buy-to-let, we should be managing our portfolios and reviewing our rental income on a yearly basis to ensure it fits with current stress testing. Obviously, important rents are raised in the appropriate manner, but they do unfortunately need to be at a level to reach the required borrowing. Personal name remortgages by clients who have large household incomes are sensitive applications. With clients who are looking to buy, we really do need to be proactive and speak to a specialist broker who will walk you through your scenario and the market up front. Don't start until you know exactly what you can borrow and have discussed products and projected your numbers, and that includes off-plan. My general advice, clients have a choice of to go for long-term overall cost, or they can project what rates they could do in the future. Obviously, we don't know what rates are going to do, but we're projecting that within 2 years' time, we should be in the new normal, so lower than now. To cushion current rate environments, clients are looking into 2-year fixes. The one word of caution I would say with 2-year fixes is that stress tests are tighter, so that will lead to large deposits. On general 2-year fixes, we're probably looking at about 65% borrowing. And also there's the product charges involved. If you take a 2-year fix now, you'll obviously have a product fee, so that may be 2, 3, 4, 5%. And in 2 years' time, you have another product fee added to your loan. So that's 2 lots of product fees added to your loan within 2 to 3 years. And if you focus on long-term costs, can be quite expensive. And the current 5-year rates overall, over the long-term cost, it works out the same. Because remember, in 2 years' time, you've got more solicitor costs, more broker fees, more valuation fees, application fees, and the costs do easily mount up. So it's important that we manage the overall cost and not just focused on the interest rate of the mortgage.
Are you the type of property investor that likes the best deals possible, but with a helping hand on the way? Well, let's face it, that's most of us. If that sounds appealing, then you should check out Property Hub Invest. It's not for everyone. In fact, it's not for many people, but for a certain type of person, Property Hub Invest is fantastic. They bring you exclusive deals that you will not find online, and Property Hub Invest is a team full of experts, people who really understand property investment. So if you want to find out more about Property Hub Invest and how it may be able to help you, then go to propertyhub.net/invest.
I guess there could be investors out there who are really swayed by going for a 2-year fixed product in the hope of switching to a better rate in a couple of years. But when you factor in the cost of switching with lender and legal fees, it could be an expensive gamble, right?
This is exactly it. This is part of the advice that I give my clients. We focus on long-term strategy with their financing. And when we do discuss the 2-year, say 80, 90% do actually end up taking 5-year option, even in the current rate environments. Like you say, you've got 2 valuations to contest with. Are your valuations going to get to what you feel in 2 years' time? You know, if your capital appreciation doesn't get to what you feel it should be in 2 years' time, it's just additional cost with not a lot of return. Also, with new build off plan, refinancing on the 2-year mark is often quite difficult. Remember, valuations and surveyors base valuations on local comparable evidence. So if you have a unit in a new build block, in 2 years' time, there's not a lot of transactions for the surveyor to grasp to give you the valuation that you feel it is at. So the valuations and the capital appreciation really comes at the 4, 5, 6 year mark, I feel.
So what are the good products out there at the moment, and what kind of rate should people be shopping for right now?
Yeah, so as we all know, rates are fluctuating quite a lot at the moment. For limited company buy-to-let purchase on a 5-year fix, I would personally run my numbers at 5.7% with a 3% fee. Again, the rate is one component of what we should consider. The lowest cost products are actually touching 5% but have larger fees. The sentiment is that lenders are pushing down rates as far as they can because low rates means lighter stress tests. But in return, we are seeing larger product fees. And that's the big thing to consider at the moment. Clients need to balance the scales between low interest rate and product fee to achieve a product that suits them. The size of your mortgage will impact the size of your product fee. Before the recent rate changes, I personally applied for a mortgage with a 5.54% interest rate because it only had a product fee of 1.5, where the lowest interest cost option was actually 4.7 and 5% fee. So I took out 5.54 instead of 4.79 because I got 1.5 product fee instead of 5%. I preferred a product with lighter fees and additional benefits, like we spoke about earlier. It's always the overall true cost that's important, not forgetting the large fees to repay. It's also really important not to think product fees are a new thing. I mean, pre-Liz Truss, specialist buy-to-let lenders were offering 2.5% as normal.
And again, similar to investors looking at a 2-year product because they're fixated on trying to get a lower rate in a couple of years, are you seeing another group of investors adamant about going for a lower interest rate now, even though any savings they make will be cancelled out by high product fees?
Yes, clients are, because I mean they're not looking at the market every day like I am, and it's a broker's job and my job to give enough context and insights into the market to help clients feel better about the product that they're taking. Again, it's always about the strength of your investment as well. You know, when you apply for a mortgage, it's the client profile is important, but also it's the property. So the better quality property you have, for example, vanilla buy-to-let, the better products you're going to get at the moment. the quirkier the property and the quirkier the tenant profile, then the more expensive your mortgage products will be.
Would you say things like new build and off-plan fall into that easy-to-get finance pool of investments?
Yeah, I mean, off-plan is a great option for clients because if you invest now, it's a way to mitigate current rates environments. Lenders do have particular criteria surrounding new build, but it's nothing ominous. New build investments aren't necessarily a hindrance with your interest rates. It's just obviously it completes in the future. So there's no way of really projecting your numbers because everything's based on the current environment. But yeah, off-plan is a fantastic way to mitigate current rate environments.
It seems that everyone is waiting for inflation to ease off, even a little, and therefore expecting the base rate and mortgage rates to go down. Do you agree with this? Are you expecting to see more products and more attractive products come to market soon?
I think we've got the current environment is going to last a little bit longer. I mean, if you go back to the original projections, when the uncertainty first started, we were looking at potentially a 5.5% base rate. So the current rate increases that we are expecting in June, maybe a 25 or 50 basis point increase in June, isn't something we weren't expecting. The current movements are a reaction into current instability in the markets, and that can pass. Like you say, the question is when we are going to see confidence and stability over the long term. I think the winter is going to be an interesting time. I hope to see rates begin to settle into the new normal post that. A new normal of an interest rate of 4.5% for a limited company investment is where I'd expect my short-term aim to be. Again, buying well and being proactive with mortgages and managing your portfolio will stand you in good stead. For me, property is a long-term investment, so the current rate environment and where it's going to go and where it's at is only one part of your journey. It's about finding the right product for you to ease you through that. And again, interest rate is one component of what we should be looking at when clients take out a mortgage.
Okay, well, we know you don't have a crystal ball, but what do you think will happen over the next 12 to 24 months? Do you think that the 4.5% that you mentioned earlier could be the benchmark for the new normal?
Yeah, that's certainly my short-term aim. I mean, like you say, no one knows what's going to happen, and the recent volatility goes against predictions. But again, it's very easy to get lost in the detail and get lost in the concerns. But I always urge clients to protect and diversify portfolios to manage any rate fluctuations. You know, rate increases are expected. You know, property is a long-term investment for maybe 20 or 25 years. So, you know, rate increases are expected. It's about building a portfolio that protects you against that. For example, one particular client of mine that has a mix of assets in there, all very good quality with good tenant profiles. Some are focused on cash flow, some are not. So the cash flow heavy investments will support the capital growth investments when we do hit an issue with rates.
That's interesting what you say about diversification of investment types. Is that something that's part of your and your client strategies?
Diversification in whatever investment you have is prudent. Any financial advisor or mortgage advisor will encourage you to do that. For me personally, I don't have all my eggs in one basket, but I do kind of have a percentage weighting in the type of investments that I'm looking at. I think we all agree that property investment is long-term, so the assets we pick are capital appreciation focused. So the cash flow wasn't huge anyway, but again, you can back that up. For example, some clients in, say, a 6 or 7 strong portfolio may have a HMO there, a good quality HMO that will support any cash flow issues with other investments. These rate fluctuations and rate movements are now like we will be looking at them on a 2 to 5 year basis. And that is only a short-term focus on a long-term investment. So again, in 3, 4, 5 years' time, we should be benefiting from better rates. And of course, our rental income would have increased in that time as well. So yields will recover. Like I said earlier, it's very easy to get lost in the detail, get worried, running around in circles. What are rates going to do? But again, focusing on what I mentioned earlier, it's about finding the right product that helps cushion those interest rate fluctuations. Again, because they are expected. There's further advances, lighter early repayment charges, like I mentioned earlier. There's lots of things out there that lenders do offer to encourage you to use their products.
Okay, well, first of all, a huge thank you to Nick. It's hard, right, to get somebody to stick their neck out and give advice and guidance on what may happen in the future, and we really pushed Nick in that interview to do that. But it's obvious the market is bonkers right now at the moment. But it doesn't mean that it's out of your control and you can't operate. Nick is clearly guiding his clients through this situation right now, and you can work through this situation. It's exactly what we've been saying for the last 10 years, is that property is a long-term investment. And this is like super important. And we're not going to apologize for going on about it all the time. But this short-term blip, when you look back in the future, Rob, it will be a blip. This is a non-event in the grand scheme of things. It just feels a bit, dramatic now. But when you look back in 10 years' time, well, you probably won't even remember. But if you do, well, there'll be loads of more ups and downs on the way. It's just a market condition that we're dealing with today.
Yeah, and remember, the reason that all this is happening is because of inflation. So when you do look back in 10 years, you're going, oh, great, my mortgage is worth a fraction of what it was because inflation's been so high. So in a funny way, it's actually helping you out. And this is just the flip side of this. But of course, that is the long term when you have to navigate the short term. And there are people who are in situations where they're suddenly looking at losing money on properties, or the profitability is radically reduced. And this is something else that we've said a million times, and we're not going to apologize for saying it again, which is you've got to use a broker. Nick spoke about where people go wrong trying to do this on their own, and he's completely right. We see it all the time. Trying to understand which product is ultimately going to end up cheapest after factoring in product fees and valuation fees and all that kind of thing against the interest rate. It's just so difficult to do it on your own. Why would you bother? And the same goes for making decisions that so many people are wrestling with at the moment, like 2-year versus 5-year fix, or balancing rate against fees. Brokers do this all day. You're never going to be able to compete with their knowledge. So whichever broker you use, this isn't just a plug for Nick, sorry Nick, but you should pay the small cost because it will work out better in the end.
Yep, it will. We've been saying it from day one, and we've been saying it for a reason. The good news is, though, that Nick, and for what it's worth, us, believe that in the next 12 to 24 months, it will settle down a bit. Rob, you've rightly pointed out that people need to be making decisions today, and it shouldn't put you off investing today either, because it is just a short-term blip, and you can make good decisions, and you can get investments that, even with this volatility, deliver you a really good return. Nick made a brilliant point about diversification, and that is something that will really help you as an investor as well. As you build your portfolio up, if you have different types of properties in different areas and you have that diversification, it will mean that some will be performing while others are flagging. But that's the whole point, right? Then you don't get too stressed that you have one or two in a portfolio that are underperforming. I've got properties because of the tight yields right now, because of the interest rates, that are underperforming, but I've got others that are going great guns and really doing very, very well, even in this climate. So I'm not concerned because diversification is looking after me there. And yes, when you go on your journey, you start with one and you're not diversified, are you? But then you build and that snowball grows, and you should seriously consider looking at moving into different property types, into different areas to offer you that protection. I know there's also merit in keeping your eggs in one basket and watching that basket very closely. That could be your strategy. But for Rob, myself, and Nick, we all believe in diversification when it comes to property investment.
Before we finish, just time for Hub Extra, that part of the show where we bring you a little bit more. Sometimes it's a tool to help you improve your life. Sometimes it's just something that we've watched and enjoyed. And today, it's the latter. Rob, you picked out Tour de France Unchained on Netflix. I know that you're a massive cycling fan, but I believe this isn't just one for the cycling nerds.
No, even though I am off to the Tour de France this year to watch them in action, you don't have to be that hardcore. Far from it. You don't have to be a fan at all. The reason why I'm recommending this as a resource is that it's from the makers of Drive to Survive. Now, many people have watched Drive to Survive and never watched F1 before, and may have not even gone on to watch F1 afterwards, but have found a real appreciation for the drivers and what they do and the risks that they take. And I think anybody who watches this will be inspired by the sacrifices that these cyclists make and the effort that they have to go to just to even complete the race. For me, cycling at that elite level is the most challenging, most difficult sport there is. I don't even cycle. I just love the dedication that these individuals put into what they do. That inspires me. And I really do feel that even if you have no interest in cycling, either participating or watching, you cannot fail to be inspired by what these people put themselves through. It's a great watch. It's only 8 parts. If you enjoy Drive to Survive or any of those other typey sporty documentaries on Netflix, I'm sure you'll enjoy this one too.
Well, that is us done for this week. Thank you so much for joining us. Thank you to Nick for lending his expertise as well. Do make sure you join us on the show next week, where we've got another very, very special guest. We are really spoiling you at the moment. Until then, have a great week. We'll see you soon. Bye-bye.
Bye-bye.